Is the month of September, aka Rextember, testing your sanity? Well, just hang in there because there's a good chance that things will get better in the next few months. September tends to be a historically bad month for crypto, but October usually makes holding on worthwhile. But aside from history, there are also some macros here that promise to give us some tailwinds. So stick around until the end as we unpack all the goodies here. See, a lot of people are worried that the bubble is about to pop. It's already all over. I think the party's barely begun. But let's take a step back. One of the main ways to tell if the USA is sliding into a recession is by GDP. 2 back-to-back quarters of negative growth usually spell trouble. Technically, that's not how they decided anymore, but it's a pretty good indicator. It's not what we're seeing right now. The last quarter showed the U.S. economy growing at a very hot 3.3% annually. The Atlanta's Fed GDP Now model is predicting 3% growth for the third quarter as well, maybe even as high as 3.5%. Now look, very healthy GDP growth here, okay? So recession fears can cool off, at least for now, but GDP is a lag indicator, so let's zoom in on something more current. Personal spending. The BEA just reported that consumer spending rose 0.5% in July after a 0.4% gain in June, adding $108.9 billion in new demand, $60.2 billion on services, and $48.7 billion on goods. Even after adjusting for inflation, real spending still climbed 0.3%, showing households are keeping their wallets open despite sticky inflation in prices. What's more telling is where the money went. Motor vehicle purchases led the charge, pushing durable goods spending up nearly 2%. Consumers, well, they also shelled out more for recreational goods, for clothing, for furniture, and food, showing confidence in buying beyond just the bare necessities. On the services side, spending grew in financial services, it grew in insurance and healthcare and in housing, core areas that reflect stability. While restaurants, bars, and hotels did slip a little bit, suggesting some tightening in leisure spending, but not enough to drag the whole picture down. Now, this mix tells us something very important. People aren't just scraping by. They're still making big purchases. They're still spending money. They're investing in their well-being. This is all very, very positive because it means the economy is doing good. And when the economy is doing good, guess what? People have money to buy dog coins, okay? That kind of resilience is not something you're going to see in a failing economy. Now let's jump to something interesting from the guys who are at Milk Road Macro. They share a nifty indicator called the Global Economic Index, or the GEI. Yep. Guys, we need a new name on that one. No, really. Anyway, tracks bonds, yields, commodity prices, and freight rates. According to their analysis, the GEI has historically been a solid leading indicator for risk assets like the S&P 500, and the charts show it is pointing up. So that's good news. Let's also look at the Conference Board Leading Economic Index, or the LEI, a trusted measure used by economists to gauge the direction of the economy. It bundles 10 forward-looking indicators like new orders, consumer expectations, stock prices, unemployment claims, into a single measure. Now, the LEI inched down by 0.1% in July, which might sound slightly bare. 0.1%. No, I don't even know what this indicator is, but it's down 0.1%. It must be terrible. Look, the board is not projecting a recession in the near term. Now, taken together, both Milk Road's GEI and the Conference Board's LEI suggest that the economy is still holding up and not rolling over anytime soon. America's back, baby. They're cooking. The economy is cranking. Now, guys, before we get into the next part of this conversation, if you're trading crypto, guess what? Legends of Crypto know why FEMX stands out. Deep liquidity in altcoins, proven security, global reach with no limits, meaning anyone, anywhere. That's you can use it. You might need a VPN in some cases. The rewards right now are next level. Deposit $200 or more, make a single trade, and you'll score $50. Boom, straight back to your account. Plus, you can unlock up to $800 plus 1 Solana in trading rewards. And to top it off, 5 lucky traders this month are each going to win 1 Solana apiece. Those are good rewards. That's a very hot deal. I've been trading over on FEMX for years. You can join me. There's a link down below where you can get started. Go check it out. Thank you very much. Okay, so back into this. Look, in Q1 2025, manufacturing contributed $2.9 trillion to the U.S. economy, about 9.7% of GDP. That makes manufacturing-focused indicators a must when tracking economic signals. The ISM Manufacturing PMI measures the sector's health based on surveys of purchasing managers. A score above 50 signals expansion. Below 50 means contraction. August reading came in at 48.7, an improvement from July, but still technically in contraction. Now, here's the twist. Again, guys, we're at Milk Road Macro. When the PMI prints 48 or lower, the S&P 500 has historically gained 20% plus over the following year. My man, what is up? Yeah.
Yeah, boy.
Meanwhile, a similar survey, the S&P Global Manufacturing PMI, paints a much brighter picture. It came in at 53, the strongest improvement in operating conditions since May of 2022. Production is rising at the fastest pace in more than 3 years, with new orders growing for the 8th straight month. People are going to have so much money to buy dog coins. It's crazy, man. Let's go. Now, all these indicators are obvious, but what if I tell you there's a stealth catalyst? Oh yeah, save the best for last, baby. We got a stealth catalyst that is about to be a dirty, stinky bear's worst nightmare. Let me ask you a question. What has been the biggest driver this cycle? ETFs? Yeah. Treasury companies? Yeah. According to a post from Alpha Extract, the real driver is Treasury refinancing, and the next 3 months are set to be insane. Here's why it matters. When trillions in government debt mature, that cash flows back to investors and has to be redeployed. Some of it goes back into treasuries, but the rest spills over into credit and equities, and yes, of course, into Bitcoin. And the numbers are pretty staggering. A massive 5.6 trillion hits the refinancing wall in the next 90 days. That's infinite US debt versus Bitcoin's 21 million supply. Plus, the Treasury's been buying back billions of its own treasuries this week. It's crazy. Here's the kicker. It's not just the size of the wall that matters. Okay, you know what they say, it's not the size of your wall, it's the something. Anyway, but how the Treasury chooses to refinance it. If they lean on short-term debt like Treasury bills, it's basically like opening up the liquidity floodgates here, okay? Investors get their cash back faster, which pumps more money into the system, almost like a stealth version of quantitative easing. It ain't QE, but they are putting money back in the system, baby. Liquidity isn't the only on-chain signal flashing green. On-chain analyst at CryptoQuant says this cycle looks different from the past cycle. Instead of a sharp run-up followed by a brutal crash, things have been much more orderly, even if it doesn't feel like it sometimes. Things are moving more slowly. But why? Well, because of the ETFs, because of the institutional demand, because stronger holders are stretching the cycle out. Good. The slowdown isn't weakness. It's Bitcoin catching a breath. This is how we move. 2 steps forward, 1 step back. Get used to it. And here's the exciting part. CryptoQuant's Crypto Dan expects momentum to return in the fall or the end of September. So instead of burning out early, this cycle looks like it is setting up for longer than many expect and a more sustainable climate. That with Bitcoin holding firm about the 100K psychological floor and leverage already flushed out in August. Autumn isn't just likely to be October, it could be the launch pad for the next explosive leg in the market. And we haven't even added the big possibility of a rate cut in September, which prediction markets are currently saying is around a 97% chance that's going to happen because of weakening labor markets. And we all know that cheap money is like rocket fuel to risk assets like Bitcoin. So when you put it all together, resilient consumer spending and steady growth signals and steady liquidity from the Treasury and a cycle that's stretching longer instead of burning out. Well, it seems to paint a picture that the macro backdrop is very bullish, and that sets us up for a Q4, potentially much longer, that could easily deliver some great gains, local top in Q4, and potentially a cycle peak later in 2026. Bottom line, pieces are lining up, liquidity is coming, and Bitcoin's fixed supply is sitting right in front of an infinite debt machine. So lock in, don't lose faith, keep an eye on the big picture, because where we're going, it's going to be crazy, man. Thanks for watching.